Have you ever wondered how traders can profit when stock prices fall? Welcome to the world of shorting. In this video, we'll uncover the intriguing concept of shorting, breaking it down step by step. Imagine buying an apartment, selling it for a profit later. Simple, right? In most transactions, we buy first, then sell. But shorting flips this process. You sell first and buy later. Sounds confusing? Let's clarify. When a trader believes a stock will decline, they short it. They sell it first, then repurchase it later at a lower price. Picture this. You and a friend are betting on a cricket match. You believe India will win, while your friend bets against it. If India wins, you profit; if not, your friend does. In this analogy, you're long on India, and your friend is short. Remember, shorting means making money when stock prices decline. If you believe a stock will drop, short it. Experience is the best teacher, but understanding the basics is essential first. Now, let's explore shorting in the spot market. Imagine a trader observing HCL Technologies. They notice a bearish trend and believe the stock will drop by 2%. To capitalize on this, they decide to short the stock at 1,990 rupees, setting a target price of 1,950 rupees and a stop loss at 2,000 rupees. If the stock drops as expected, they buy back at 1,950 rupees, making a profit of 40 rupees. Conversely, if the stock price rises to 2,000 rupees, they incur a loss of 10 rupees. Thus, a successful short trade occurs when the stock price falls. In the spot market, shorting must be done within the same day. Why? Because the exchange expects you to deliver the shares. Not covering your short position can lead to hefty penalties. Avoid short delivery situations by closing your short before market closure. Moving on, let's discuss the futures market, where shorting is unrestricted. Traders can initiate a short position and hold onto it overnight. You can short futures similarly to shorting stocks but without the intraday constraints. For example, if a trader shorts HCL Technologies at 1,990 rupees in the futures segment, they'll see their profit or loss calculated daily through a process called mark-to-market, M2M. If the stock price declines, they profit. If it rises, they face losses. Key points to remember. Shorting involves selling first and buying later. You profit from declining prices. In the spot market, shorting must be intraday. Futures allow for holding short positions overnight. Margin requirements are the same for both types of trades. Now that you know about shorting, consider how this strategy can be part of your trading toolkit. Want to learn more? Dive into shorting practices and start trading smart.